Since January of 2025, Kenya's economic storyline has been one of numerous ups and downs. For the last 12 months, headline inflation eased into single digits, remaining well within the central bank's target range. The shilling remained questionably stable, trading in a narrow range against the dollar. During the period, the government also moved to make good its commitment of selling state-owned enterprises, with the most notable transaction being the announcement of its plan to offload 15% of its Safaricom stake to fund infrastructure and reduce borrowing pressure. And as Jimmy Mbogo now reports, the interplay of those three threads shaped markets, policy choices, and even public debate through 2025.
2025 was an year of contrast. On one hand, you have policymakers who believe that the policies they're making for the economy are pushing the economy towards the right direction. On the other hand, you have economic analysts who believe that the policies that are being made are not right for the economy. My name is Jimmy Mbogo, and this is my reflection of the year 2025 and everything that happened in the economy. Data from the National Bureau of Statistics shows that for the better part of 2025, inflation has remained well anchored within the target range of 5 plus or minus 2.5%. In the first quarter of the year, inflation averaged at about 3.5% before increasing in the second quarter to average at about 3.8%. In the third quarter, however, inflation rose slightly to average at about 4.4% before rising further in the last quarter of the year to average at about 4.6%. But does this translate to a low cost of living for Kenyans? According to the National Treasury Principal Secretary Dr. Chris Kiptoo, low inflation has translated to low commodity prices in comparison to 2023, but admitting that more could be done to lighten the burden on Kenyans.
So yes, that is still an issue. We think that more could be done to improve the income levels of Kenyans. And that's the aspirations. When you hear we want to up our ambition to be a first world country, that what are we saying? We're talking about per capita income. When we talk about per capita income for Kenya now at $140 billion, you're talking about 2,000 shillings around there. But you know, a country, about 2,000 maybe dollars. But you know, other countries like, you know, Singapore and others, you know, you're talking about over $50,000 per year, I mean, per capita income. So to reach there, means there's a lot that we have to do.
But experts disagree. Although inflation remained well within the central bank target range, economic analysts say inflation is merely one side of the coin. Ken Gishinga, an economist from Mentoria, argues that low inflation rate that the country has experienced in 2025 is largely due to a subdued demand owing to weak economy, where demand has been weakened. Gishinga faults the country's monetary policy for only focusing on price stability and ignoring damning data on employment.
So there's a big trade-off between inflation and unemployment. So the problem in Kenya, as I've said times without number, it's not really inflation, but it's unemployment. In fact, we're approaching a place where the demand is so weak that businesses cannot sustain their normal customers, and some of them have to shut down.
In 2025, it wasn't just inflation that remained stable. The Kenyan currency also remained stable for the better part of the year, raising questions including from the International Monetary Fund, IMF. In 2025, the Kenya shilling traded at a surprisingly tight corridor, a development that Treasury officials attributed to stronger foreign currency inflows, improved liquidity from exports, and a surge in diaspora remittance. The narrow trading range calmed importers and reduced pass-through pressures to domestic prices. However, stability led to suspicion from multilateral institutions.
One of the things the IMF told us when they were in town 2 weeks ago is that the exchange rate is too, that they think it is interfering with the transmission and that it is interfering with inflation targeting.
A concern that has also been expressed by economists who warn that foreign exchange market was overly static and characteristic of a floating exchange rate, but the government has insisted that the stability seen this year is likely to continue.
So if you look at it all, it just points to the stability being pointing to management of the shilling, at least to ensure that it's within the current levels. And why do I think it's been managed? The restoration of the FX interbank markets and the impact of all this is at least to ensure that our external debt services is certain.
We stick to our long-held stance on non-interference, and again, we don't. We have not told banks not to hold their to stick to a particular exchange rate level. And I think as a way of, it's just, testing the market, to go and see if you have some dollars with you, see whether you can go and sell those dollars at even 131 or 132 shillings to the dollar.
The economy has done well, and you can see exports of goods have performed well. You will see we have had foreign exchange inflows from coffee, tea, and other commodities that we sell. Our export receipts from services have also done well, particularly from tourism and other services. You can see that there have been a growth in revenue, in foreign exchange. And more importantly, we have had a 6% increase in remittances over the last 1 year, for instance.
Faced with a high debt level and competing development priorities, 2025 saw the National Treasury accelerate its divestiture from key state-owned enterprises. Among the high-profile privatization drive of 2025 was the proposal by the government to offload a 15% stake in Safaricom in exchange for 245 billion shillings to serve as the seed capital for the infrastructure and foreign wealth funds, a move that experts believe was not prudent.
In this particular version of divestment, it's a bit strange because I think, number one, first of all, you want to begin with the loss-making entities before you actually reach the highly profitable entities. You want to offload as many of loss-making entities. Number two, the proceeds of those sales, in as much as they go into the national infrastructure, there are more needs that a country has for those funds beyond infrastructure.
But according to Treasury officials, this was informed by the need to finance development, particularly in agriculture, through the construction of dams, roads and the energy sector to power industrialization, while reducing the need for fresh borrowing.
This National Infrastructure Fund is going to get the initial capitation from the proceeds of privatization and divestiture. We are targeting about 600 billion shillings. Already we have identified over 300 billion shillings from KPC and divestiture of Safaricom alone. That will give us close to 350 or at minimum 300, maybe and 20.
But what are we saying? The departure from the other privatization is that the proceeds that we received from other privatizations that we undertook went to finance the budget. This time around we have said no, we don't want to get money and put in the budget, and then we spend. We want to leverage the money that comes in through the infrastructure fund, which is being set up, so that if we say we raise $3 billion, we can leverage up to 10 times that amount.
Going into 2026, the government says it is optimistic that interest rates will continue to fall, allowing credit to flow to the private sector. Analysts have expressed concerns over the new NSSF rates, which they fear will further strain the wallet of Kenyans. Jimmy Mbogo, Citizen TV, Nairobi.